Wanted to take a look at SPX, the index for the S&P 500, and to do some stock market analysis. Now we've got some really important economic data last week. We have more economic data coming out this week. So if your stock market analysis focuses on economic data and how that moves the market, this is what we're going to be looking at. First, we got inflation data points last week. We also got personal incomes and personal expenditures. Now, incomes and expenditures here in the United States drive revenues for companies. Income and expenditures are slowing down on the rate of growth. This will mean that the rate of growth of revenues for companies is going to do the same, slow down. We're starting to see that. We're seeing the consumer not spending as much. We're seeing incomes go flat. This week, of course, we've got non-farm payrolls, and this could really rock the market if we see numbers that are coming in lower and lower. This will be expected, but employment is sort of a lagging indicator, so we may not get there. We may not have a really ugly number this month. It may take 2, 3, 4 more months before we start seeing some of the effects that the Federal Reserve has put on the economy. At the same time, last Friday, PCE, the price index for personal incomes and personal expenditures, is still showing signs that there is inflation and that it's not moving to the 2% target rate that the Federal Reserve is looking for, and they're going to keep interest rates higher for longer. Initially, the stock market sold off on this news, then rallied because basically this is what's going on with the market in general. The market will start to pay attention, say, hey, listen, bad data points, interest rates are moving higher. They start to sell off stocks. Then they say, but who cares? Let's jump in. I'll show you some charts and what could happen this week going forward with the stock market using economic data. Let's jump in. Here's a good look at SPX, the S&P 500, the index for the S&P 500. And all the way on the left, you can see that big spike higher in volume and the green bar going upward. This is a 3-minute bar chart. That's 0830 New York. I live in Mountain Time, so 0630 down below if you're trying to figure that out. So I'm 2 hours behind New York. That's when PCE, personal incomes, and personal expenditures came out. Initially, of course, it popped higher. The SPX popped higher, but then sold off. Now, I walked into the market as I normally do, options trading. What I did was I bought puts and calls right at the open. I figured we'd get some kind of movement. I wasn't really sure what kind of movement, which direction, whether it'd be up or down. I took my profits because I was able to clear the cost of the put and call. I used 0 DTE right at the money when the market opened at 0930 New York, 0730 my time. The market fell down, and I kind of expected it would. I took my profits on both the puts and calls, walked away, tapped out. I actually kind of looked at the market when it really kind of got ugly, and I thought, you know, it might bounce a little bit. I played around, looked at some of the options for going long, call options, 0 DTE, thinking, you know, we might see some kind of pop. The 52.20 level I felt was pretty much a kind of a given, but unfortunately what goes on is you have to pay for that, and that I was using SPY stock to buy those puts and calls. I didn't think that I'd clear the costs and that I'd see that kind of movement. I definitely didn't see that big movement at the end, but by then the market was pretty much closed. You would have been moved out of your position anyway. So that big move higher, you had to have carry your options over for the day. Otherwise, you'd be carrying the underlying. Regardless, the market initially took a look at that and said, sure, this is going to work out just fine. Then they sat there and bought in heavily, and that's because of the bond market moves. But here's the daily chart. You can see the big move from all the way down late October. I want to say pretty close to the 1st of November, all the way up. We have seen about a 1,250 point move higher in SPX from there, which is almost a 25% move in less than 6 months. The economy has been booming, but there's sort of a pushback on that because of what's going on with the Federal Reserve. They're going to keep interest rates higher for longer. Incomes are finite. So it sort of acts as a tax that because of all the debt that's been accrued, individuals aren't buying as many cars because the cost is too high. Demand for mortgages is dropping because mortgage rates are too high. Things are cost prohibitive, which means the economy is starting to slow down. So the effects we're going to see on this is that consumption is going to decline. For now, everything's flatline. I do have some charts on that. Here's a look at personal income and personal expenditures. If you're looking for stock market analysis for beginners, or stock market for beginners using economic analysis, this is one of the most important things that I look at. Everything in the economy is driven by personal incomes. We do have business expenditures, we do have government expenditures. Government expenditures tend to be very flatline. They don't really go up or down, so they don't really drive the economy too much unless you get something that's an outlier, such as the Anti-Inflation Act, where there were some infrastructure projects in there that would create new jobs, and it's something outside of normal expenditures by business governments. But for businesses, they follow demand. So if we get a year-over-year change on incomes, meaning more and more people are being hired, and that's adding to the aggregate for total incomes in the economy, that drives expenditures. Taking a look at these charts real close, you can see that personal incomes is below median or middle. Pretty much that tells us that revenue growth for companies at this point is going to be below median. So all these ultra high stock prices that we've been seeing, because investors have chased lower yields, those are gone. And this is really going to start to kick in. And I've been saying this for a few months now, September, October, November, December, going into the last portion of the year here. You're probably going to see the stock market moving lower. And as you can see, personal incomes and personal expenditures, they go hand in hand. As people earn on a rate of growth, year over year change, if there's an increase in personal incomes, you'll see the same in expenditures. Now, inflation numbers also follow expenditures. If demand increases on expenditures, this pushes price pressures. And if it decreases, it lowers price pressures. I can overlap these charts and they look fairly similar. Core PCE is falling, but not nearly as fast as the Federal Reserve is going to want to. First, we've got the U.S. presidential election. The Federal Reserve isn't going to do anything prior to that. They're going to wait until after that. I expect their first move, should they move this year, wouldn't be until the November 6, November 7 meeting, which is Wednesday and Thursday, right after the 5th of November, the U.S. presidential election. By then, there could be a lot of damage to the economy, that the rate of growth would go not even quite to median, but below that. We're running at 3.8% unemployment at this point. Given that big of a unemployment number, or that low of an unemployment number, that big of employment, there's no growth potential because everybody's already on the payrolls. 3.8% is incredibly low. Here's non-farm payrolls monthly change. You can see we're getting lower and lower. I don't see any catalyst for a number above. Now, we get revisions all the time. If you look at the data points, the last 3 months always have a P written right next to it for preliminary. They always revise it. So the last 2 months, along with the new April data point or May data point, we will be getting revisions to April and March. They could be lower, which the market would not like at all, because that shows that there's less growth going on. Here's a look at the unemployment rate. I think it was April of last year, April 2023, where we hit probably the low point, the nadir in this particular number. 3.8% is incredibly low. We're still firing away. So what to expect with the stock market this coming week? I expect a lot of sort of sideways up movement. I don't expect anybody to really start selling off. You might get some savvy investors getting in on Monday and saying, you know what, I'm selling into this rally. We've got Friday. So Monday morning, when this video will be released, we could actually see some selling at the beginning as people take profits from this big move we just saw at the end of day Friday. They're getting ready for this Friday coming with unemployment and non-farm payrolls, and another look that the consumer is slowing down, and therefore business hiring will likely slow down as well. Another sign that the economy is starting to slow. We've been seeing these signs. But at the same time, inflation, another lagging indicator, along with employment data, has not caught up yet to the slowdown in expenditures. It takes time for businesses to hire and fire. They don't just wake up one day and say, we sold 1% more yesterday, so let's go ahead and hire 10% more people. It takes time. And we're starting to see a lot of those effects hitting the economy. It'll take 3, 4, 6, 9 months before a lot of companies fully respond to the slowdown in the economy. When they do, that means layoffs, which means we go back to personal incomes. We didn't even hit median. And we're going to start seeing a slowing down in the rate of growth, the year-over-year change, which means revenues to companies will go lower, which means these ultra-low yields that stock investors have been pushing for, they're going to get out of those. They're going to take profits on those. That's and I do expect September, October, November, December. I've been saying that for several months. I've been saying that since all of last year, that's when we start to see a real big move lower in the stock market. We'll see where it bottoms out. This is economic data dependent. We'll continue to get more and more economic data. Make sure to hit the like and follow button if you are just finding my channel for the very first time. If you're looking for written content on this kind of stock market analysis where I use economic data to break down what drives the stock market, I've got my Substack link down below and at the end card here on the video. We'll see you in the next video.